Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, how do I analyze an open interest in stock options? Answer by Varun Divakar. What is open interest in options trading? Open interest is a very good indicator of the investor activity in a stock/index. In contrast to the daily volume whose increase or decrease is not directly correlated to the strength of the move, the open interest is a direct measure of the strength of the move in a market. To explain further, if a rally in the price of a stock is associated with an increase in open interest, then you can be certain that new positions have been added or that there is a renewed interest in the stock/index. This is an indicator that can easily be used in futures and options trading. Today let us try to build an open interest trading using Python to check some basic assumptions about what open interest indicates. Where to find open interest data? First, let us pull the data of a stock/index and verify the open interest from this open interest data. Let us pull the futures price of the stock SBI, State Bank of India, and check the trend in its price and open interest. It is common for a stock to increase its open interest when the contract becomes active, or front month. Conversely, as the stock approaches expiry, its open interest decreases. So, to check if the open interest of the futures is increasing or decreasing, we will have to take the combined open interest of the front and second month futures contracts. This will give you the complete picture and avoid any abnormality during the contract rollover. Options trading using open interest. In this blog, I will show you how to pull the futures data of the Jan contract, after it became the front month, and then we will pull the next month contract, February, information for the same time period and check for the combined open interest. I have used the package NSEBI, thanks to Swapnil Jariwala for sharing the code, to pull the data of NSE stocks. Pull the data. Let us print and check both contracts data. Data_food contains the futures data of Jan contract and data_food2 contains the futures data of February contract. Now, let us combine the open interests of both the contracts and plot the change. Plot the data. Next, we make a continuous contract that rolls over after expiry and check the stock's performance for the same time period. As you can see, I have combined both the futures contracts with the close prices of the Jan contract until its expiry and later with February's contracts. Analyze the data. Now let us analyze how the stock traded and if there was an opportunity for us to trade in this combined open interest chart. First, let us put these two charts together, then you can see that the combined open interest starts to decrease well before the expiry, but the price keeps increasing. This is generally considered a bearish signal, as it indicates the fact that either of the traders is winding up their positions or beginning to short, and hence the open interest is decreasing. This leaves us with a good shorting point just before the expiry, when the divergence increased significantly. I will leave you with a small but important table that will help in identifying the strength of the trend. For the final confirmation, let us pull the options data for the same stock with the same time period and verify. Conclusion. As you can see, the open interest of the options contract has also shown a significant reduction before the expiry. This further strengthens our belief that a correction is on the cards. Answer by Arpit Pauser. Option trading is a special kind of trading which helps to all the investors to do trade more sophisticated. It is performed for the right to trade stocks or futures at a specific price over a definite time period, or selling the authority to someone else to trade stocks or futures for a specific price value over a definite time. Here options offer rights, not compulsion. Although you have the authority to purchase the stock in option, you are not allowing compulsion to perform. You can permit the call or set just to refer to expire be supposed to you so choose. Here this is dissimilar than buying the fundamental stock absolute. Whenever you purchase it, you possess it. It says you are forced to own it once you purchase it. However, that is precisely the status you are in. On the conclusion, option trading provides the trader return. However, the real trading is not away from its possibility. Expectantly before anyone employed into the options empire, they are prepared with fundamental, at smallest, the facts about this creature called options. The trader must be familiar with the basic difference between a call and a put option and a buyer and seller trader. Options trading are similar to stock trading in many aspects. You can trade in any variant like as buy or sell. Calls were built for the investors who want to trade and buy a stock with free stock trading tips. On the other hand, puts were built for the investor who needs to sell a stock. Here, stocks are not the only assets which provide options. It is an investment medium that gives the potential to build money, evade a portfolio and, on common, offer covers the stocks or attachment in someone's account. Hence, it turns to another method to play the market. Options trading doesn't have to be a competition of market monitoring anymore. The investors with the best trading tips, such as stock trading tips or free option tips, they have an extremely good success ratio and proven consistency. The trader can make benefit from their information and create making money with it. The greatest trading information wants their achievement to be your achievement too. Let's find out how effortless trading options can essentially be for you. Answer by Jay Shah. By looking at the maximum open interest position near the particular call and put strikes, you can find out the range. For example, at present the max SOI in Nifty calls is at strike 10,500 followed by 10,400. So these levels will act as resistance. Similarly, 10,000 strike put has the max SOI, so it will act as support. You must have noticed that, while interpreting options, the calls and put SOI act as opposite. Max call OI strike is a resistance, though call are for long traders. The reason being, the biggest participants in options are options writers, sellers. So, if 10,500 call has max SOI, institutions have sold maximum calls at this strike, as they believe markets will face it very difficult to cross those levels in near future. Whenever the range breaks with faster move, say Nifty breaks 10,500 in next 2 days with strong momentum, it could be a good breakout trade on the upside, as lot of short covering happen when the levels break, which adds further momentum into the markets. The only problem is these range keep changing quite often, so just relying on that might not work. It should be used in conjunction with technical analysis like trend and pricing action analysis. The analysis remains the same for stock options. The only problem is very few stocks have very active options with high liquidity. So choose the stock wisely while trading options.